Welcome to the channel. I'm the Swedish dividend investor. The support continues to be amazing from you guys, and we are already closing in on 300 subscribers. So, a massive thank you for your support. If you're new here, we talk about dividend stocks and ETFs, and we do valuations, all with a sweet Swedish accent. So if that sounds like something you're into, make sure to obliterate that subscribe button, turn on notifications, leave a like and leave a comment. I'm always open to chatting with you guys, on topic or off topic. So, for today's video, we're going to take a look into Mondelez, ticker MDLZ. I also want to brief you after that part, so make sure to stick around till the end. As always, make sure to read the disclaimer in the description. Alright, Mondelez. Let's read about their business. Mondelez International Inc. through its subsidiaries, manufactures, markets and sells snack foods and beverage products in the Latin America, North America, Asia, the Middle East, Africa and Europe. It provides biscuits and baked snacks, including cookies, crackers, salted snacks, snack bars and cakes and pastries, chocolates and gums and candies, as well as various cheese and grocery and powdered beverage products. The company's brand portfolio includes Oreo, Ritz, LU, Cliff Bar, Tate's Bake Shop's biscuits and baked snacks, as well as Cadbury Dairy Milk, Milka and Toblerone chocolate. It serves to supermarket chains, wholesalers, supercenters, club stores, mass merchandisers, distributors, convenience stores, gasoline stations, drugstores, and other retail food outlets through direct store delivery, company-owned and satellite warehouses, distribution centers, third-party distributors, and other facilities, as well as through independent sales office and agents. The company also sells products directly to businesses and consumers through e-retail platforms, retailer digital platforms, as well as through its direct-to-customer website and social media platforms. Mondelez International Inc. was formerly known as Kraft Food Inc. and changed its name to Mondelez International Inc. in October 2012. The company was incorporated in 2000 and is headquartered in Chicago, Illinois. As you can see, we will be using seekingalpha.com for the numbers, like I tend to do with American companies. Let's go through some quick stats before we dive into the numbers. 10-year performance at around 66%, 5-year at 30%, and 1 year at around 4%, with the lowest price being at around $56 in February. Here we have their quick dividend stats. Around 2.7% yield, payout ratio of around 57%, 5-year growth rate of 10.5%, 11 years of growth, and they pay quarterly. And by the looks of it, they pay in the July range. So January, April, July and October. Let's quickly jump over to the dividend growth to check their long-term growth. Hey, that's some pretty decent numbers. Between 10 and 12% compounded annual growth for the 3 to 10 year. Let's keep that in mind for the valuation. Checking their dividend history, we can see their consecutive dividend payments has a streak of 23 years. And zooming out, we can see the cut at the end of 2012 and a very nice growth from there. And the last thing I will check is their dividend yield over time. Looks to me that the average yield is around 2 to 2.3% with a high of just above 3%. So right now, you would be buying on the higher side. Are you enjoying the breakdown so far? Alright, as usual, it's time for some spreadsheet autism. I've punched all the numbers and we're going to start with the charts. Now, the numbers are for their 2024 whole year. Why do we do valuations? So we can guesstimate what we could get out of our investments and so we don't overpay. Looking at the charts, I would say pretty strong cash flows and somewhat steady. Revenue and earnings trending upwards, a bit slow, but they are going up. Then we have their balance sheet. Nothing too crazy going on here. The debt is shrinking, but so is their cash position. Moving over to the numbers. If you want to have a look at all the numbers, just pause the video. I'm going to go over the most important ones for me. Starting from the bottom, shares outstanding decreasing, which is a good thing. That means we will own a bigger share of the pie. And since their debt is decreasing, one would think that the share buybacks is with their own cash. Like we saw in the charts, their revenue and net income is going up. Not every year, but during this 5-year period at least. And I also make an average for their earnings, to use as a conservative number for the valuation. And I would say, if you're going to buy a company, you should at least count on holding it for 5 years. At the top, we see their cash flow and dividends in billions. The free cash flow payout is around 55 to around 66%. 5-year average cash flow is sitting at 3.28 billions, and the price to free cash flow ratio is sitting at 27.55. Pretty highly valued cash flow here. To the right we can see my notes, mostly the numbers from Seeking Alpha. Scrolling up to my quick stats, we have a lot of yes here. I put a no for the free cash flow payout, since the last dividend was at 66.68%, and when using the 5-year average, the payout ratio is above 70%. This is again to be a bit conservative. We can't always expect sunshine and rainbows. Bad times will come. I put a no at the debt being payable with 5 years worth of cash flow, since the total debt is around 18 billion, and the 5-year average free cash flow times 5 is 16.4 billion. They also get a no for their free cash flow valuation. What I do here is I take their 5-year average cash flow and give it a multiple of 15 and compare that to the market cap. In this case, that is sitting at 90 billion versus the free cash flow valuation at 49, give or take. Now, do they all have to say yes? I would say no. It depends on the valuation. Speaking of it, it's time for the free cash flow valuation. Like I said before, we're going to be using the 5-year average free cash flow. I did some quick math for their annual FCF growth for the last 5 years, and it is sitting at 3 to 4% roughly. So I've gone with a discount rate of 10%. This is our required return. Why 10%? Well, that seems to be the number everyone throws around to be the average market return. Normal case, I've gone with 3% growth and a terminal multiple of 27, like we saw before. This is the multiple the market is willing to pay 10 years down the road. Present value, 67.82 billions. Now, keep in mind, this is compared to the market cap, not the share price. Best case, I've been generous. 5% growth, terminal multiple of 32. We land at a present value of 88.42 billions. So, pretty close to the market cap. So we would need a growth of 5% every year for 10 years and the market to be willing to pay 32 times for the free cash flow. Moving on with the worst case. Now, as far as I understand, Mondelez has some headwinds with the cocoa price getting out of control. So let's see what happens when we put 0 growth for the first 3 years and then 1% for year 4 to 10. Terminal multiple of 15, and we land at a market cap price of 40.74 billion. Oof. Like always, since we don't know the future, we do a mixed valuation. And I've gone with a probability of 60% for normal and 20 each for the best and worst case. We land at a fair price of 66.53 billions and 59.87 billions with a margin of safety of 10%. That's about 37% over where we're at today. Moving over to the dividend valuation. I might be generous here. Normal case, discount rate of 10%. Growth of 7%, terminal multiple of 38, so a yield of 2.63% at year 10. Present value, $66.84. Best case, 10% growth. Like I said, I might be generous here. Terminal multiple of 42, so a yield of 2.38%. We land at a present value of $90.58. Worst case, I went with 2% growth for the first 3 years and then 4% growth for the later years. Headwinds are coming up, but also inflation. And in the later years, maybe 2% growth and then 2% inflation. Terminal multiple of 30. We land at a price of $42.49. Mixed valuation. Probability of 60-20-20. We land at a fair price of $66.72 and $60.04 with a 10% margin of safety. Comparing that to the share price, we're not too far off. My least favorite valuation method, but we will count it anyways. Earnings. Why is it my least favorite? Because earnings can be manipulated more easily than free cash flow. Now, their growth for the earnings has been about 7% per year. So, for normal case, I've gone with 5% growth. Terminal multiple of 19. That's their current PE. We are looking at a present value of 77.25 billions. Yikes. Best case, 7% growth, multiple of 22, present value of 97.53 billion. Now, this is what needs to happen, the best case. Can it happen? Yes. Is it probable? That's for you to decide. Worst case, 1% growth for the first 3 years and 3% for the rest. A multiple of 12, and we land at a present value of 50.07 billion. We also do the mixed valuation here, 60-20-20 probability. We land at a fair price of 75.87 billion or 68.28 billions with a 10% margin of safety. So not looking good here. Now, I have added a page for my research called Macro. I looked at their latest annual report and it talked about some of the headwinds. Here's what I copied. During 2024, price volatility and the higher aggregate cost environment increased due to international supply chain and labor market disruptions and generally higher commodity, transportation and labor costs. We expect these conditions to continue to impact our aggregate commodity costs. In particular, we expect to face higher cocoa costs in the near and medium term due to these factors. For example, the market price for cocoa beans on the Intercontinental Exchange in London was 161% higher on the last trading day of the fourth quarter of 2024 compared to the same day in the fourth quarter of 2023, and it's likely that prices will remain elevated for some time. It is possible that we may not be able to increase prices sufficiently to fully cover the incremental costs of cocoa prices in this environment, and/or our hedging strategies may not protect us from increases in cocoa cost, which could result in a significant impact on our profitability. If you want to read more, download their 10K. Scroll down to the overview. Item 1A is the risk factors. A good read, but too long for this video. And item 7, commodity trends. Now, let's jump over to the main page. That is not looking good. Every valuation is red, meaning overvaluation. The only one that comes close is the dividend, with a ratio of 0.96. Everything above 1 is undervalued. The more it goes above 1, the cheaper it is. And here we have the mixed valuation. This is adjusted per share and takes all 3 valuations into account. So the FCF, dividend and the earnings valuation. Between $52 and $57. The low end is with a 10% margin of safety, so not terribly overvalued. Like I said in the beginning of the video, we were at a low of around $56 in February. Conclusion: I would say put this on your watch list, and if you like their business and their strong brands, follow their price and maybe put an alarm if they go below $58. So, what do you think? Was I too generous? Not enough conservative? Do you think Mondelez is a buy, or do you already own it? Let me know in the comments down below. So, a short briefing as I promised. My to-do list is growing. I am going to make a downloadable version of my spreadsheet I used in my video, how much to invest for $100 per month. I also have a bunch of stocks I want to do research on. One particular is Aker ASA, but the information is quite limited and I would need to grab their numbers from their annual report. I will get more information on when my employee is coming back this coming week. And when he is back, I can do a bit more on the YouTube side. For now, some things will be put on ice. But guys, that's it for this one. I hope you enjoyed it. If you did, make sure to smash the like button, subscribe and all that good stuff. I'm the Swedish dividend investor and I will see you in the next one. Stay smart, stay patient and keep stacking those dividends. Ha det gött!